Last week was really a do-or-die moment for our markets, with the battle of the timeframes raging on in full force and threatening the breakdown of our weekly higher-low zone. Now, of course, we know that Thursday and Friday we got a face-ripping rally in the upward direction, and the structure underneath us remains intact on the weekly timeframe chart. From a daily perspective, the question now becomes, will we see follow-through into the previous overhead area of balance? That'll be the main question that we evaluate in today's episode of the Weekly Watchlist. Of course, anything that we're associated with is linked down below in the description. Quick thumbs up before we get started is a great way to support the channel. Stay tuned until the very end of today's show. We've got 4 additional trade ideas to share with you, and with all of that said, let's dive right into the charts. So let's kick things off on the SPY monthly time frame chart now that February has officially closed out, evaluating candle structure and location as we always do. The candle in question is the red inverted hammer, the upper wick, of course, representing a failure from the buyers at the top of the monthly range. We know that we moved through the opening print for some range expansion in the downward direction, that's the red body, and we closed fairly weak towards the lows of the monthly range as well. So structurally speaking, sellers are in control here. If we think about location on the bar-to-bar count, we have produced a higher low as well as a higher high, which strikes me as being slightly more bullish than bearish. But in the context of this overall inverted head and shoulders pattern on the monthly time frame, which is right here, the upper wick is a bit more significant, seeing as it's a fake break of that neckline and a failed move to accept and start expanding range in the upward direction or following through from this reversal pattern. So it doesn't mean that we flip to being bearish all of a sudden and we're expecting markets to make a new low underneath the October low, but it means we might still have some serious interest in seeing a monthly close over the 410 area on the SPY monthly time frame chart. The reason is, if we close above 410 with a monthly bar, you can see by looking left, the next big structural resistance on the monthly time frame chart is way up overhead closer to 460. I'm not advocating that we go here in the coming weeks worth of trade or even the coming months worth of trade. I'm just pointing out that things are not really as bad as they seem just because we have this failed upper wick on the February bar. To be concerned about new lower low outcomes in this market, we would have to break down underneath the right shoulder of this pattern here, which is much closer to roughly SPY 380. So once again, doesn't have to do with what we're expecting on Monday's session, speaking to the overall odds, the higher time frame perspectives, that things are really much more sideways in this range here, as opposed to threatening a big breakdown for new lower lows. And we're certainly not close to making new higher highs, new all-time highs. Let's be clear about that as well. So overall, 410 on the monthly time frame chart remains significant from a pattern perspective. Let's move on down to the weekly time frame chart and see what's going on here from a structural and location perspective, and we'll notice that it's the exact opposite. We've got ourselves a green-bodied hammer candle, the long lower wick representing buyers stepping up towards the lows of the weekly range, moving through the opening print to close extremely strong at the highs of the weekly range. So structure definitely goes to the bulls. If we think about location on the bar-to-bar count, we've produced a lower low, but also a higher high. So technically an outside bar here, which is significant from an overall story perspective, right? If you're telling yourself the story of this chart, we had a 2-bar inside play that broke down in the past 2 weeks worth of trade. We should have seen, if the sellers were going to remain strong, continuation underneath that bar's low. It simply wasn't the case in the past week's worth of trade, and instead, we've now closed above and right on the edge of that weekly balance. So sellers not really doing anything impressive here on the weekly time frame chart, and we can continue to count the trend as low, higher low, looking at this as now a newfound higher low with highs and higher highs as well. The next step would be an equal high and possibly higher high to continue this trend on the weekly time frame chart. What else can we say about structure here? Well, we've got a bullish backtest that's holding of our weekly resistance trend line. We have closed above our weekly 50 SMA. We have closed above our weekly support trend line here. And if we take out the Fibonacci's from the low of this move up to the high here, you'll notice that we've held on to the 38.2, which was offering confluence right around this area. So to me, structurally, this is a pretty bullish looking chart. I will concede that we are still underneath the 2-week balance here, but for the most part, we're holding up at the ideal zone of that key higher low on the weekly time frame chart. I do want to share with you a perspective here with our anchored VWAPs on the weekly time frame. So coming in from the all-time high as well as our October low, this is quote unquote the pinch and the squeeze that everybody's been talking about. We've supported off of the VWAP from the October low, and this could act as resistance into the coming weeks worth of trade. If we break above it, Can we assume that we're going for the equal high on the weekly time frame chart? I would say bullish odds improve. I wouldn't assume anything in this market. So overall, weekly time frame chart does strike me as being slightly more bullish than bearish for all of the reasons that we've just discussed. If we take a look at our volume profile chart as well, this will continue to support the idea that we have, again, found support at our high volume node. If we are moving through the thin volume void, we should, in theory, be attracted to the next overhead high volume node, which is closer to these equal highs, around 420, 418. So I'm currently seeing the evidence from the structure, location, everything that we've just discussed, that the weekly and higher time frame charts are not necessarily bearish by any stretch of the imagination. Weekly chart remains in an uptrend, and now we're looking for confluence on the daily time frame chart. So on the daily time frame chart, let's first evaluate the weekly expected move. If you're not familiar with these numbers and where they're coming from, video tutorial in the top right-hand corner. Overall, if we're contained by the upper edge here, the number is 412, it would imply a higher high above last week's high, but more importantly, price acceptance within our overhead range. If we're contained by the lower edge of the weekly expected move, the number is 396.50, and it of course is implying a higher low holding above Thursday's low, which once again is more bullish than bearish. So expected move here is definitely on the bull side of the market. Now, it's important to recognize, though, that the daily trend remains down with highs, lower highs, and the opportunity still for a lower high at this bottom of balance, 404.50. That's the key resistance as we move into the early stages of the coming week's worth of trade. If we reject off of it and move lower, that would be, as we could call it, a break, retest, and continuation. So 404.50, key resistance early on in the coming week's worth of trade. But there are some other bullish things taking place here. Let's walk through those now. First of all, from a moving average perspective, we've held the 200 and we've recaptured the 50 SMA. We also have, if we take out the Fibonacci's from the low up to the high, a beautiful hold of the 61.8 Fibonacci, which is always a line in the sand. We never actually had a daily close underneath. Recall that as you close candles underneath any 61.8, generally speaking, the odds dramatically increase for the 100% retracement. It simply didn't happen on our daily time frame SPY. We've also closed back above or near our 38.2. I wouldn't definitively call it a capture just yet. Really got to get price acceptance back in this overhead balance range, but steps in the right direction. Of course, if we can poke into this area and then find a higher low above, that would certainly be more bullish than bearish. We've also, from a balance range perspective, built out a balance area here and broken over the top of it as of Friday's close. So in between 404.50 and in between $400.75, I think the market's kind of neutral trying to figure things out. If we reject back into the range here, don't get me wrong, that is bearish from the daily time frame chart, offering a lower high here. Also from a pattern perspective, we would have look above and fail, always targets the bottom end of the range. Then key support is back in play at 393.50. The market can't really afford to get underneath 393.50 because from a low count perspective, we have lows, lower lows, lower lows, and then an equal low, which was found here. So if the market does violate this area, then we are no longer holding that weekly higher low zone, and there's cause for concern that, of course, the daily downtrend can continue and jeopardize the weekly structure that we've just discussed. So that's the bear case scenario underneath $400.75. The bull case scenario, as we've alluded to, is a breakout above, continuation above 404.50, finding any kind of higher low pullback above, and then we are back on the bull side of the market with a new daily uptrend trying to form with lows, higher lows, highs, and then looking for some kind of higher high, right? That's kind of forecasting into the future here. Now, the reason I would have a slightly bullish edge is not only because the higher time frames are holding at bullish locations, but if we think about the psychology of what unfolded last week, really Thursday and Friday had quite a big impact. On Thursday, we actually gapped down underneath. Let's go to an hourly time frame chart. We gapped down underneath our key area of support at 393.50. There was no acceptance on these lows from the sellers. There was no attempt to move the market in the downward direction. Even on the attempt for a gap fill reversal, it was, completely reversed from the comments from Bostic. You could use that as sort of a catalyst as to why the market moved higher there. Then on Friday, we get a gap up. There's a partial gap fill. Remember that sellers should, in theory, close the gap all the way. Sellers did not do their job there. Nobody wants to be short this market. And what do? We grind higher the entirety of the day, breaking out over the top of the balance we just showed you on the daily time frame chart and moving right to the target at 404.50, the prior lows from this area in here. So if there's no selling momentum, and we'll see this in the internals as well in just a moment, and we've basically had a seller's shut-off pattern, right? Think about it took 3 days to grind down here, maybe even longer than that, right? We've got 1, 2, 3, 4, 5, 6 red days, all retraced over the course of 2 green days. Certainly seems to me that the buying momentum is certainly much, much stronger at this point in time than the selling momentum, and therefore, with the higher time frame structures remaining respected with higher lows, with the daily chart showing signs of improvement holding the equal low above the daily 200 SMA, 61.8 fib, above the 50 SMA, above the top of the range here, I would definitely be looking for bullish outcomes early on in the week. Once again, to wrap it up from a scenario perspective, bulls want to see a break over 404.50, higher low above, start a new daily uptrend inside of this balance here. The target over time would be 416.75, the top of the range. Neutral if we pull back for a higher low but remain kind of in this zone right here. And sellers, I'll give you credit when you deserve credit. If you start to push prices back down underneath $400.75, we will consider this a look above and fail. The target will be the bottom end of the range at 393.50, and from there, we'll take it step by step. Supporting evidence, Exhibit A, market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. This week's interpretation is extremely simple. All we're going to do is compare the strength of the buyers from Friday to the strength of the sellers from the previous portion of the week. From a volume flows perspective, it really was not bearish by any stretch of the imagination. Early on in the week, we had some slight outflows on the net read, but look at what takes place on Friday. Friday was so significant that not only did it move over the 300 million mark, but it flips the net weekly flows to being positive and in a significant manner. We closed here roughly just shy of 400 million. Remember, a significant read is 1 billion. The reversal that took place over the course of one trading day here does strike me as significant from an inflow perspective. That's bullish. Early in the week, the net reads in the advanced decline line were still above the zero line for the most part. On Thursday's session, aggressive rally out of trend zone. There was no time spent in trend zone as the market was selling throughout this period of time here. Friday, of course, is substantial closing in trend higher zone above 1500. Once again, more bullish than bearish from a breadth perspective. And the tick cumulative build speaks for itself. I mean, this is just very, very visual down here. Was there any selling momentum as the market was moving lower? Absolutely not. Was there buying momentum as the market was moving higher here? I mean, clear as day, well above positive 5,000 on the cumulative build. It's very clear to see, based on the data in front of us, that the buyers really have the momentum when they're pushing the market higher, and the sellers don't have anything going on from a strength perspective as this market has broken down from the previous daily balance area. Supporting evidence Exhibit B is the market profile. If you're not familiar with this one, top right-hand corner's got you covered with a brief tutorial. Overall, let's compare Thursday and Friday to the earlier stages of last week. Thursday, value area is engulfing of the Friday value, but most importantly, notice that the point of control actually moves underneath the Wednesday point of control. That's not great, especially considering that the market closed at the highs of the Thursday range, so a small divergence from that perspective. And although value is definitively higher on the Friday session compared to Thursday, it is lower in Friday's range overall, and once again, the point of control does not migrate higher and close with price at the top of Friday's range. This would speak to the idea that it's okay to expect a higher low pullback to tag up to one of these VPOCs, find support off of it, and then attempt the break of that 404.50-ish area equivalent on the SPY chart that we were just looking at. In the ES futures, it's 40.55. So this is telling us, hey, value is moving higher. The point of control did technically move higher right here. You can see that overall, the point of control is above all of the previous points of control from last week, Thursday as well, but it didn't quite get all the way up towards the highs here. Expect a reasonable pullback. Maybe things are getting slightly extended in the upward direction, but if we find a higher low around this area, then we're good to go. An equal high break is up next, which once again is the equivalent of your 404.50 on the SPY. So back on over to Thinkorswim to evaluate the weekly performance of our sectors, we'll notice that the XLB materials sector led the pack, up 3.54%. Unfortunately, it's a really lightweight sector and doesn't mean a whole lot for our markets. At the bottom of the barrel, we have XLU for utilities, down 1.03%, which actually is more meaningful considering utilities are a risk-off asset class. Great to see them lagging as the market was actually making a move in the upward direction. The heavyweight tech sector was sort of midway through the pack, up 1.95%. Let's check in on the structural charts and evaluate what's going on from a trend perspective. Here's materials. Once again, really lightweight sector. It does start to mean more as it's starting to make significant higher highs. So watching for it to hold above 84.25 to be a bullish force for the S&P. If it falls back down into range, it's exactly that, kind of just more neutral, being that it's a lightweight sector. It becomes bearish if we take out 79 in the downward direction. Here's the energy chart. This is D for defensive from a posturing perspective. So once again, we do not want to see leadership here, and it's not threatening leadership up and over 93. So from that perspective, so far so good. In a picture perfect world, this would just play nicely in the lower half of the daily balance area here and turn around for a lower high underneath 87.54 in the coming weeks worth of trade. We don't want to see it falling off of a cliff. We don't want to see it dramatically drop underneath 82.67. But again, no leadership, please, out of the energy sector. Next up is industrials, 8% of our S&P 500 breaking out over what appears to be like a monthly or weekly bull flag. So the more time we spend above 103, the more of a bullish force it will be for the S&P 500. We want to see it come into 105.25 and then on pullbacks find a higher low above the top of this balance at 103. That is the bullish case for industrials. If we fall back down underneath 103, it's still a-okay, looking for sideways higher lows above $100.50. Bears start to gain some traction under $100.50. Next up is communications, finding that beautiful weekly higher low. Remember that the big concern for markets was the tension between the daily downtrend and the weekly uptrend. The XLC has come in for a significant daily pullback. This has been kind of brutal, but it is finding that weekly higher low above the prior top of the balance range in here. So as long as we spend time above 52.17 from the weekly perspective, good to go. And on the daily time frame chart, nice gap up on Friday, recapturing the low flush point here at 54.30. Bulls ideally want to see a little bit of upward lift and then higher lows start to form on the daily time frame chart for an inverted head and shoulders reversal above 54.30. So it looks good as of Friday's close with that gap up holding and also not getting any hang up at these upper wicks that were offering daily lower highs. So 54.30 in communications. XLC, really impressed with the activity out of this one. Notice that we get a daily close above our key zone at 139.25, accepting back in the overhead supply. Breaking out of this area here and certainly holding for a weekly higher low above 135. This chart has to strike me as being more bullish than bearish. We can afford some sort of higher low, something that looks like this, as long as we continue to hold 135, good to go on the XLK. But in a more bullish world, right, it's acceptance and continuation above 139.25. We will reevaluate the bear case when and if we drop underneath 135. Next up, XLY, consumer discretionary, also trying to make a stand for a weekly higher low somewhere around the 50 SMA, around this gap fill area. Recall that this one is not as clean as the XLC communication sector, simply because there's the balance range and we have certainly fallen back into it. So a big area of resistance to watch here is 148. This will be a top priority of mine early on in the coming week. If we turn around here for a lower high in the daily time frame chart, that would be a bearish cause for concern for our market. So really watching XLY around 148 early on this upcoming week. Real estate, lightweight sector, much more to do with the wealth effect, playing nicely, just going sideways in this overall range, caught some support off of 37.25, kind of neutral for the S&P. Financials is all about 36, right? We recall that this was a really tricky area, started to break out as an inverted head and shoulders, and then this now overhead supply broke down, right? So 36 needs to resolve. If bulls are going to see follow through in the coming weeks worth of trade, financials need to break out over 36, right? It's going to be very difficult for the SPY to make a significant move if the XLY finds a lower high off of 148. If the XLF can't get above 36, it's going to be really tough to see that follow through. So watching financials to break 36 as a bullish force for the market in the coming weeks worth of trade. Utilities, as we pointed out, is a D for defensive sector, and it completely lagged this week. You can see it falling off of a cliff here. That's great. I mean, as the market's moving higher, as we're seeing that rotation and the other heavier weight sectors picking up the slack, that's okay to see the sell in utilities. But if the remainder of the market's going to kind of pause here for a little bit, we don't want to continue to see it falling off of a cliff. Really wants to go sideways here. It's not really threatening leadership by any stretch of the imagination. Next up is the consumer staples space, and this too is D for defensive. Notice that it's just hanging out in this balance range, right? Look below and fail. Even if we target the top end of the range, it's not exhibiting leadership, threatening a big break of 74 just yet. So once again, playing nicely. It's not breaking down aggressively. It's not also offering leadership. Good to go from a posturing perspective. XLV, this is the healthcare sector. This one is a slight cause for concern, noting it's the second heaviest weighted sector by market cap. Recall that this was thin structure. It's been a slow grind through it in the downward direction. Not as slow as what we had in here, don't get me wrong, but really aggressive turnaround on Thursday and Friday session. It's all about the back test of 130.50. If we find ourselves a daily lower high up against that, once again, it's probably going to be difficult for the SPY to continue in the upward direction. It's got to get back above 130.50 in healthcare. Really need to see this participate, or at least not continue its downward descent off of a lower high at 130.50. So watching XLV and watching XLF specifically into the coming weeks worth of trade. Here's the sector ratio grid to visualize relative strength and weakness, top right-hand corner if you need to know how to set this one up. Overall, the top 4 sectors are the heavyweight risk-on sectors, and I would continue to reinforce the idea that risk-on still looks okay. Notice that XLK is threatening a break of its bull flag consolidation from the ratio grid. I would say that the XLV is certainly struggling. We saw that on the daily chart, which is why we're keeping an eye on it. Financials as well, struggling around that 36, but if we get a break of 36, I would imagine this perks up slightly. So again, structural chart will rule in those cases, but notice it's not in an aggressive downtrend. If anything, it's just taking a pause going sideways. This, healthcare, different story. Definitely more of a cause for concern here with healthcare. Then the XLY discretionary, nice bull flag continuing to remain intact, still above an upward sloping 50 SMA. So risk on continues to still look positive and in force, so to speak, and the bottom 4 sectors are the risk off sectors. Last week, we were concerned about the perking up. Notice that they have come off. Notice that this is still perking up, but underneath what could potentially be a double bottom neckline and the 50 SMA. Real estate also continuing its grind lower. Another perspective that I want to share with you, which is definitely more bullish than bearish, is taking a look at the weekly time frame chart of the XLK ratio. And just notice that if we come in from this most recent high doing something like that, breaking this resistance trend line has to strike me once again as being more bullish than bearish from a risk on posturing perspective. Let's have a look at the XLY over the XLP for growth versus value. And what we'll notice is that this did not continue to break down underneath the lows set here. We have not had to come all the way into the back test of the 50 SMA and the lows that were set in this gray zone here. So far so good, noting that this is once again still an indication of risk on being the primary appetite of the market at this point in time. We're just watching for that poke up and over, roughly 2.1 in this particular ratio. Just in general, the shape of this chart would suggest that risk on is more in force than risk off. Having a look at the dollar, we'll notice that there was no aggressive higher high produced over the 105 area, which in theory means that we can be comfortable about bullish outcomes in equities. Now, the threat still certainly exists for a weekly inverted head and shoulders, and when and if the higher high comes over 105, certainly would put bearish pressure on equities in the downward direction. Now, a comforting sort of perspective would be just taking a look at the gold contract here and noting that we have much more of a substantial higher low that's being found off of the top of the previous balance, right? This was the balance. We're finding this higher low, and as gold moves higher, in theory, it should prevent the dollar from also moving higher, which would sort of give us a way to avoid bearish outcomes in equities from the dollar relationship perspective only. It doesn't mean that this is the only thing that impacts equities, but it's certainly something substantial to consider. So gold looking good here as long as we can hold roughly 1820 in the GC contract. Let's have a look at the TNX interest rates and just make some comments about still being over the neckline of this weekly double bottom, right? So even though we saw a sharp reversal on the Thursday-Friday session off of this high, we're still well above 3.88 in the 10-year, which is cause for concern in the tech sector specifically. If we were to break down underneath these lows, there's still an opportunity for a higher low, right? If we're just evaluating trends, the TNX is a big threat at this point in time, especially noting that the Fed is supportive of a higher rate policy and for substantially longer than we may have expected at first. So speaking of what the Fed is being supportive of, notice that the odds of a 25 basis point rate hike are falling, while the odds of a 50 basis point rate hike are continuing to increase. Now, it's very rare that Jerome Powell gives us what the market is not expecting. There's only been one instance in this hiking cycle where he's gone past the expectation. If you recall, that was June of 2022, and there were some pretty bearish outcomes for the market when that actually took place. Now, are we going to get a big miss? Are they going to give us the 50 basis point rate hike? It's possible, but with multiple Fed speakers coming out in the last 2 or 3 weeks even saying, hey, we were more supportive of a 50 basis point rate hike in the last meeting. We don't think we should have tapered off to 25 so soon. Are they trying to soften the impact of the market's expectations if we do get a 50 basis point rate hike? Possibly, right? It's really a game of psychology between the Fed and the market and the expectations of what the rate hike will be to determine whether or not they actually have to do that big sort of rug pull and give us the 50 basis point rate hike. If they can just sort of hint at it enough and the market responds well enough to that expectation, then they can sort of go back to the 25 basis point rate hike and say, hey, we're going to maintain credibility. We're going to do exactly what we said we were going to do. We're going to stick to these 25 basis point increments, and they've sort of done their job without having to shock the market with that rug pull. Once again, it's not my job to determine whether or not the Fed is doing the right thing. It's my job to interpret what the market's expectations of the Fed are and how that impacts volatility. Speaking of volatility, expect a volatile week with Jerome Powell testifying on Tuesday and Wednesday. JOLTS and unemployment is coming out this week. So overall, from a fundamental perspective, we'll keep it pretty simple this week. We know, right, just to sort of stack the data points, we have record low unemployment right now, which is not recessionary by any stretch of the imagination. We do have extremely terrible Q4 earnings of last year, which is more of a threat for a recession. And there's the risk of a credit event. We talked about this in last week's episode with outstanding consumer debt reaching an all-time high, close to $1 trillion, and defaults are actually on the rise. We know that this has nothing to do with how we should act on Monday at 9:30, but we need to be open to volatility if we start to see more signs of weakness from a fundamental perspective that are paired with, here's the key, that are paired with technical breakdowns in this market, aka moves back down into the lower balance and possibly a flush of SPY 390, 350. Having a look at some of our risk appetite charts, TLT bonds are up first. Notice for the most part, we're underneath this significant consolidation from the ratio line. And if we zoom in and recall what we were saying in last week's episode, the slight outperformance here has been erased as we moved into the later stages of the previous week's worth of trade. There's no obvious flight to safety that's taking place that I can see in the TLT. If we take a look at the HYG, which is, so to speak, smart money up top versus dumb money equities down below, the bullish divergence has played out. And now we're actually seeing a negative divergence where equities have made a higher high, getting a bit ahead of themselves, whereas the HYG junk bonds have not, right? This is speaking to risk appetite sort of stabilizing and saying, hey, if we get a minor pullback in equities, it's not the end of the world as long as this kind of low holds in the HYG. This speaks to the same idea that we were discussing in the market profile and seeing a pullback to possibly the VPOC, Virgin Point of Control, from Friday's range, right? Saying, hey, let's tap the brakes just a little bit, find a higher low pullback, and then continue on our merry way if the HYG wants to confirm with a move up and over roughly 75. Let's take a brief look at the Bitcoin chart just to get a sense for what's going on over in the crypto landscape. I would still say that there's a decent risk appetite remaining above this breakdown candle high and using it as support at $21,500 per coin. Once again, it does not have a one-to-one relationship with equity markets, but overall financial risk taking right now seems to be intact as long as we're above 21.5. If we start breaking down underneath, things could possibly change and maybe we start to change our tone on this perspective, but for now, definitely has more of a positive indication for equities as we move forward. Next up, we've got some market breadth indications. This is new highs versus lows perking up off of the zero line. Recall from last week's episode, this was a big red flag sitting right on the zero line. The fact that we've resolved this in the positive direction does strike me as being more bullish than bearish. We want to, of course, morph into a look that looks like 2021, bullish outcomes in equities, and avoid more of a breakdown look like 2022, where equities suffered in a big way. And so far, this is a step in the right direction. Once again, strikes me as more constructive and more bullish than bearish. Let's take a look at stocks above their 200 SMA in the S&P 500 specifically, trying to find a bit of a bottom here, trying to find some sort of support above the 50% mark. Once again, above the 50% mark, fairly difficult for the market to see substantial drawdowns in the downward direction. Notice that 2022 when the market was struggling, for the most part, we were underneath the 50% mark the entirety of that year. This does strike me as being more hopeful and more optimistic as opposed to being bearish. Last week, we were also concerned about stocks underneath their 50 SMA in the S&P 500, and we're right back at the 50% mark here. Last week, we were here. This week, we're here after a small drawdown. Once again, the more time we can spend above the 50% mark, it speaks to being more resilient in our market, coming in for reasonable pullbacks instead of full-on breakdowns underneath the 50 SMA. So this is a step in the right direction, but still a red flag. I would say new highs versus lows and stocks over their 200 SMA are certainly more hopeful looks. This one has some work to do, getting above that 50% mark. If we take a look at the RSP equal weight S&P 500, this will be useful in the coming weeks worth of trade to see what the reaction is at the bottom of the balance, right? This is closer as compared to the regular weighted S&P 500. Zooming in here, notice that there's some more room to run, right? So if I just draw this back in, the equal weight should come into this first, and we will learn something about the market, whether or not it rejects off of that or if it breaks through. It would imply, if it breaks through, that the S&P could at least get to this prior topping area in here in the bottom of balance and possibly see bullish outcomes above. If RSP breaks down underneath, think of that as a negative divergence, doesn't really speak to great outcomes in the equities market. So we'll learn something this week when we actually test that level. And the same thing can be said about the Dow divergence here. Recall that just like we had a bullish divergence taking place on this break that was not confirmed by the industrials. We also have the same thing taking place in the downward direction. There was a threat to the bottom of the range here. There was no confirmation by any stretch of the imagination from the transports, still kind of struggling to break down into the prior balance range here. So this is not confirming specifically any one direction just yet. If transports continue to outperform and stay above this 14.8-ish area, we of course want to see that confirmation out of industrials over the top of this balance, closer to 35K. It's not the case as of right now. So still treating this as a divergence, not being overly confident in moves until these two things start to come into sync and confirm with one another that we are seeing true strength in either direction. Doesn't matter, but we need to see both moving in sync in either direction. More bullish data points coming out of our VIX, making a significant move underneath that 2050 area. Recall that this would imply that the market is fairly content with this as a low. This is a reasonable higher low pullback, and now this is starting to look once again like a very reasonable higher low pullback. The more time the VIX can spend underneath 2050, the more significant and comfortable the market will be with that low holding. Let's take a look at the VVIX, volatility of the volatility index. Hard to say that this is not bullish, completely collapsing down to the bottom of the range at 75. Do keep in mind that this would open us up to the complacency effect where we could spiral out of control if data comes in way hotter than the expectation. Say in Jerome Powell's testimony, he drops an absolute bombshell that's bearish for the market. He hints at a really hawkish tone, right? We're opened up to the complacency effect here, but so far so good. This speaks to the market once again being fairly comfortable with these higher lows holding in place as of right now. Let's take a look at volatility futures coming into a deeper contango here, still underneath the zero line. Once again, speaks to less risk in the present day versus the future, which is exactly what money managers want to see to allocate capital. Finishing up the broad market with the QQQ and then IWM, notice that just like the XLK, the Qs have actually poked into the overhead balance here. Bulls want to see prices hold above 296.50, higher lows, continuation in the upward direction. Key resistance will be 302.75, and this gap close area from right around in here. Weekly expected move, just like the S&P, is bullish, getting more acceptance in the overhead range, and also suggesting a higher low above the low of what was produced last Thursday. We're above the 200 SMA, above the 50 SMA, and we've also broken out of this daily balance area right here. Very similar comments from the S&P. Let's take a look at the IWM where things are ever so slightly different. We'll see that on the weekly time frame chart in just a moment here. The main difference is really that there was no lower low produced, right? No lower low on the Thursday session, whereas the Qs produced a lower low and the SPY really produced an equal low. This is actually a higher low. Very nuanced, but certainly more bullish than bearish, noting that the IWM and small caps definitely act as more of a risk on, risk off type measure. We've broken out of this daily balance. We've started to accept in this daily balance. The expected move once again is bullish with a higher low suggestion or just spending more time in the overhead supply. Pullbacks want to hold above 189.75 for constructive looks that start to do this. And of course, then we can start to eyeball an inverted head and shoulders pattern. The target would be the top of the range, the weekly expected move high as well. So right around 196 even. Once again, all of this speaks to improved bullish odds, the fact that the heavier weight risk on sectors, the tech cohort, as well as small caps, more of a risky investment asset class, are looking more bullish than bearish. Right now, the S&P is actually the laggard. And our side-by-side weeklies, just to round things out, notice hammer candle, notice hammer candle, notice hammer candle. Notice we are underneath the pivot high. Notice we are above the pivot high. Notice that we are above the pivot high here. Once again, considering that this is the heaviest weighted constituent tech really in the S&P, this speaks to bullish outcomes. This speaks to risk on, as we were just pointing out. This looks great. This is the laggard. Could it play catch up? Could we make that equal high sooner rather than later? Absolutely could be the case based on all of the evidence that we've put together in today's episode of the Weekly Watchlist. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that said, we'll dive right into Apple, seeing a substantial reversal on the Thursday-Friday session, closing right at the bottom of the balance area here at 151. Now, this puts Apple in an interesting predicament because on a relative basis, we know that the Qs actually moved into the overhead balance area here. So if the Qs pull back to try to find a higher low, it would imply that Apple actually finds a lower high underneath this balance area and then we would look to see what the reaction is around 147.25, the daily 200 SMA, the low of Friday's session. Can we actually find a higher low here, or do we fail? If we fail, we know that the rotation is to the daily 50 SMA and 142. If we hold for the higher low, the next long is through the equal high, the recapture of the bottom of balance at 151, and we can target 154 and 156.50, the top of the flag respectively. Let's continue along and take a look at Netflix. Some interesting divergences taking place here. I don't want to zoom in too far yet. Relative strength over the past week's worth of trade, anything but that, really hanging out down towards the lows of this week's range. We did not see a substantial reversal on the Thursday-Friday session. So because of that, I would not be overly thrilled about bullish outcomes here in Netflix. As a matter of fact, a flush of 311 actually looks fairly interesting for the rotation into 298, our next downside target, the double bottom neckline from this previous structure back here. So that's the bear outcome. And even if we start accepting in this general area, I would chalk it up to chop. Overall, in the daily time frame chart, we're certainly building out a more substantial downtrend with a clear and significant lower high underneath 332.50, right? So even if we play around in this range, that's fine. I would only start to be interested in upside outcomes if we could recapture 332.50. So that's Netflix. Overall, Tesla, what's going on with Tessie? Still putting in this bull flag consolidation up here at the highs, just not wanting to go lower on an intraday basis, even as Investor Day came up as a bit of a miss, just in the midpoint of this flag range. We've literally closed right on the level at 197.50. I'll continue to reiterate that I think that the better long is still being patient and waiting for the move over 213 from the higher time frame perspective. Don't get me wrong, you can scalp this thing all day long, back and forth, long, short, whatever, but the better and higher confidence long is still over 213. We've really got to resolve this range before something substantial happens in Tesla. Next up is Google, which I will maintain a bearish stance on simply because of this head and shoulders is playing out, and we are still underneath the neckline. So there's still a strong opportunity for Google to find a daily lower high somewhere around this 94.25 area. There's a lot of talk about Google in the headlines, sort of botching the release of their AI bot, the Bard thing. So all it's going to take is just another sort of slip up with either Microsoft outperforming or releasing something significant, or Google messing up and slipping, so to speak, to find a lower high off of this level and then doing something like that. That's sort of integrating the fundamentals with the technicals, right? Continued lower highs underneath 94.25 are undoubtedly bearish. Spending time underneath the head and shoulders neckline targets ultimately would be the low here at $90 even. If it's going to flip to being bullish, fine, let it be constructive, let it produce a higher low above, then it's the exact opposite pattern. We are yet to see that out of Google, one step at a time, bearish until proven otherwise. Next up is the metaverse, Zuckerberg's fantasy land here, just absolutely exploding to the upside on the Friday session. This could be thought of as an inverted head and shoulders, moving over the neckline here back into this original gap up range from the earnings cycle. So you could continue to play it in the upward direction. We don't really have structural elements to be watching for. Just put very briefly, higher lows want to remain above the low of the original balance here at 180.20, midpoint and some rejection around 188.75, top of the range, 195.70. Very, very simple, just watching for higher lows to maintain a bullish stance or continuation into those two zones we just discussed. NVDA, really resilient, especially on the way down, right? Barely looking into the gap, not accelerating, sellers not doing anything impressive. Now closing back at the top of this range, you're watching for breakouts and continuation over 238.25. The only bearish trade here is once again failing underneath 229. That level has been incredibly strong. If we take a look from an intraday perspective, have a look here, right? Resistance. When it broke, it really broke and sent us right back to the top of the range. So overall, 229 is the key zone. As long as we're above it, hard to be a bear inside of NVIDIA. Next up, let's take a look at Softy. What's going on here? A little bit of a confusing chart. I'm not going to lie about this one. It's not offering the most clarity considering that this was the overhead range. Recall that this was support that led to this move. Hammer candle low in here, rejected the bottom of balance here. We're sitting right on it. So overall, this is lacking clarity. We're coming off of a lower low. So in theory, you could look for a lower high off the bottom of this overhead supply at 255.50. If it does continue, looking for this gap to close overhead on a reversal, right? You've got this interesting zone here at 250.75. This is a day-by-day case until we actually get some stronger moves out of Microsoft. Intraday from the hourly chart here, I mean, no doubt about it. That's an ascending triangle. Looks like a pressure cooker top. Looks like it wants to break in the upward direction. Just want to be mindful on the daily that this is still an overhead area of previous supply, which is weighing down on price. Next up, last but not least, is the mini beast Amazon. Very similar to Google, as we've been pointing out the past couple of sessions. There's your head and shoulders. shoulders, underneath the neckline, looking for lower highs off of 96. Could we break this 94.70 area to get there early on in the coming weeks worth of trade? Absolutely. If we take a look at the hourly time frame chart, we even started to do it into the close of business on Friday. A little bit of continuation, then I would look for rejections off of 96, simply because of the daily pattern that we just explored. Head and shoulders still indicating bears are in control as long as we're underneath that level. Just like Google, maybe we'll become slightly more constructive if we get a higher low above, but as of right now, bears have the upper hand. Last reminder for a thumbs up, subscribe, bell button, all that good stuff YouTube tells us to tell you about, and let's dive right into these trade ideas. First one is on QCOM, that's Qualcomm as a company, looking for the breakout over the two equal highs from Thursday, Friday, 124.15 for a day trade scalp into 126.65. Here it is on the hourly time frame chart, perhaps a little bit more clear. Notice that this prior low right in here is continuing to fail. Sellers are not making it happen underneath, not making it happen underneath. We've closed back inside of, you could think of this as a balance range, and now if we crack these two equal highs, looking for the top of that range at 126.65. Next up, we've got PEP, PepsiCo. What's going on in this one? Again, the hourly chart will suffice to explain the structure. Daily hammers in play, right? And you'll notice that we've got these equal highs, looking for 173.50 to break to get the rotation into 174.75 for a quick dollar or so in the upward direction, retesting the overhead supply lows in this general area. Again, this is a quick scalp. This is not meant to be something that you hold for weeks on end, waiting for this little dollar little move in here, right? This is a quick trade, something to watch early on in the week. Not so quick for a trade is going to be JP Morgan. This one's actually got to go out to a weekly time frame chart, and this one is simply a bull flag, pullback, bull flag forming again, higher lows along the way, looking for the break of 144 to get us into that next structural element at 150.50. That target might be a little bit easier to see on something like a daily time frame chart. If we just grab some more time here, I can show you where that resistance is coming from. It is where we saw the push and then fail, right? So that's kind of what this is coming from. 150.50 on the break of this ascending triangle pattern forming here for an upward move. Once again, this could take a little bit longer to unfold, will likely take longer to unfold. And last but not least is another weekly idea from Shop. This was something that we had brought up in the past. Here it is on the daily time frame chart. Then we'll go to the weekly. Notice that we have a break over this range high as well. And we've got thin structure through this gap down from the last earnings cycle. If we take a look at the weekly time frame chart, notice that we have an outside engulfing bar, so a lower low was produced. Sellers did not materialize here. We've closed over the previous week's high, and we know that there's thin structure in here from a gap down from earnings. That could mean that the target could be substantially higher. Let's go to the daily chart and find target together, and that will conclude today's episode of the Weekly Watchlist. So first place to look for would be the bottom of the gap at 46.92. Then the gap closes all the way up at 50.18. Not making the case that we go all the way here in the coming weeks worth of trade, but you can just get the sense that there's thin structure, not a whole lot of overhead resistance if we get continuation off of Friday's move. That's going to wrap up today's video of the Weekly Watchlist. If you enjoyed it or learned anything new, let me know down below in the comment section or by giving the video a thumbs up. Don't forget that we will be live tomorrow morning at 8:30 with the pre-market prep. Hope to see you there. With that said, I wish everybody a green trading week.